It's that time of the month where I'm going to give you the 5 stocks to be watching or buying this next month or even over the next 6 months to a year. And these stocks could be making you a lot of money. I'm going to break down exactly what they are, what they do, and how much money they can make you. Let's get into it. All right, now I'm not going to hold you hostage with your time. So here are the top 5 stocks you should be watching starting in June 2026. We have number 1, HIMS, 2, Celsius, 3, Salesforce, 4, ServiceNow, and 5, Micron. Now, this is not in any specific order, but I am going to go over them in this order. So if you can, please give a like and subscribe. I really do appreciate it. Now, these are the top stocks, and this is what they've been performing, right? We have HIMS the last month, 7% negative, negative 39% in the 6 months, and 12 months, 55%. As you can see, most of them have been down. I did start this list a week ago. Micron has gone up a lot since then. If you know anything about the end of May, it has gone up. So I didn't want to change my list. It was just what it was going to be, but it's gone up significantly. But even if you look at the 12-month, the 6-month, and the 1 month, it's really the only one that's gone up other than ServiceNow over this last month. Micron's the one that has been going up, but I'm going to explain why I think it could still even double up from the current price it's at right now. So here we go. First, HIMS and HERS. They recently did a loan, a $300 million. It's actually ended up being about $400 million debt offering. Now, just to kind of quickly put it out, make it simple, this is a special kind of loan from institutional investors. They borrowed $350 with an extra $52 that did get exercised. HIMS is going to pay 0% on this loan, and they do not have to make regular cash payments. The twist is instead of getting their money back in cash, they the people who loaned the money, the lenders have the option to swap the debt for HIMS stock. But they can only swap the debt if HIMS share price is above $29.53, which it will be very soon. If the stock stays below that, they typically get their cash back at the end. So HIMS, if I believe it actually is at that price, maybe it's very close. So HIMS is going to be, I believe way above that price. Now, why did HIMS do this? Well, to pay for the acquisition of Eucalyptus and to invest heavily in their AI capabilities and fulfillment infrastructure with, their whole Wegovy thing, and they want to compound. They got peptides, so, or they're not compounding, but they're going to compound other things, but they're going to be having peptides and all that stuff. So the protection against dilution. So obviously the problem is, if the stock price rockets and the lenders convert that debt into shares, right, that's going to create new shares and dilutes the value of current shareholders. Well, they did this thing called a capped call. And what it basically does is it offsets the dilution. They effectively raise the price at which dilution would have actually hurt shareholders. And it's up to $50.15, almost double. It's actually double. So if you think about that, that is really good confidence, right? That's good confidence. It's also insurance, right? Because they understand like, hey, our stock can easily get there. Now, the EPS is the biggest factor. The basic EPS is not going to change because that's based on how many shares are actually, out there. But the diluted EPS will take account on what would happen if all the shares got exercised. So the diluted EPS number is definitely going to go down. But the silver lining is because HIMS purchased capped calls, the dilutive pressure on the diluted EPS is basically neutralized until the stock crosses $50.15. So basically what this is signaling is management expects massive growth, right? They are explicitly stating that they believe that their stock price is going to hit basically that, right? They have insurance up to that price. And if the management thought that it would top out at 30, they wouldn't even waste money having insurance up to $50. So that's really good. So the cap calls, essentially, a cap call that is significantly above the stock price is a strong bullish signal. So that's really good for HIMS. Now, obviously, we know about their Wegovy, right? They just started doing that March 26th. Their first quarter numbers were not good, but that's because of the whole lawsuit, the Wegovy stuff, the Novo. Now everything is just going, right? They have all these recent acquisitions from the lab facility, Peptide, YourBio, and then we have the international from Zava, H&H Canada, and Eucalyptus. And Eucalyptus, all these numbers are going to be put later on in the second half. So that's going to be raising their revenue as well as all that other stuff. So for the second quarter, they're expecting 680 to 700 million. But for the full year, they're expecting 2.8 billion to 3 billion, which would be about 19% year over year. Everyone wants to talk about peptides. At least that's, I hear that a lot because I look into HIMSS a lot. So peptides are kind of considered the future of healthcare right now. In the FDA, there are some that were classified where in category 2 where you couldn't compound them, pharmacies couldn't use them and sell them. And so the FDA is now on July 23rd and July 24th, they're going to be having a meeting to reclassify peptides, and that will allow HIMSS, it says right here, it will allow compounding pharmacies, HIMSS, to manufacture certain peptides. So that's good that HIMSS would be allowed to do that. Why are peptides the future? They have precision targeting, they mimic natural molecules, and they have very few side effects. They have lower toxicity, and then they're faster to develop. So, the toxicity, they're made up of amino acids, so your body breaks them down better, and then the faster development, they're just easier and cheaper to design and create. So, and then the peptide market is also going right now a gold rush. Right now it's 80 to 140 billion, the current market, but it should be about 300 billion in the next 8 years or so. So it's going to go up significantly, and HIMSS wants to be one of the leading manufacturers and suppliers. Over the last 5 years, as you can see, the interest in peptides has gone up, and since 2004, obviously a lot. So, but peptides are not out there like just so easily. It's like a gray market thing, but they're good for you. It can be good for you, but there needs to be a little bit more tests. Obviously, there will be some long-term side effects, as well as just eating. If you eat any kind of fast food, you eat anything on any kind of consistent, you're doing the same thing. You're putting some kind of chemical in your body, right? So either way, though, they do need to make these tests and figure out exactly what the long-term effects are. There's a lot of gray market, but if the FDA reclassifies them, that will allow HIMSS and all of them to start making it. It doesn't mean it's FDA approved. It just means now they can start testing and doing a lot more to get it FDA approved. Let's look at HIMSS, what the company looked like in 2020 and what they look like in 2026, right now. So the stock price, this was the SPAC, it was Special Purpose Acquisition Company. It's basically like a shell company that looks to buy a company, which was HIMSS. And so it was about $10, right? Now it's about $25. So it's gone up about 155%. That's great. Quarterly revenue used to only make 30 million per quarter. Now it's 608 million, right? That's up a lot. Now the net income, well, they used to lose 6 million. Now they lost 92 million, obviously, but they've done a lot of acquisitions and stuff like that. So, and then the whole Wegovy and the lawsuit that hurt them. This was the last quarter, so that obviously is not good. And then the quarter EPS, because they lost the money, lost all that money, whatever. But the subscribers, 217,000 to now 2.5 million. So the company itself is doing a lot better. And I believe that this thing is just going to be skyrocketing over the few years. So we'll see exactly what happens, all right? But HIMSS is my number one stock to watch. Number 2, Celsius. I also talk about Celsius a lot. I think Celsius is going to be extremely profitable for people, investors. They had a revenue of 782 million, which is 138% year over year. Their portfolio share reached 20% of the tracked energy, and the Alani Nu integration is basically completed. This is the biggest one, though. They're getting additional space in, like on the shelf. They're getting 17% more for Celsius and 100% more for Alani Nu. Alani Nu brought in so much money for them and was such a driver, a growth driver. And so getting more space for Alani Nu is going to be great. Now, it does mean that they're going to have more shoes to fill, more shelf space to fill and sell. If they can consistently still sell at 99.5%, because they're essentially saying 99.5 for every 100 cans that they put in, 99.5 get sold. So, As long as they can keep this going, that will be great. But if that shelf space adds up and continues to go up and then they can't keep it up, then the next year they're going to show shelf space decrease, and that would make the stock go down. So we want to make sure that this ACV continues to be very, very high along with the shelf space growth. And then they have the number 3 energy portfolio in the US, which is great. Revenue went up 138%, net income went up 148%, and adjusted diluted EPS went up 128%. The EPS was 33 cents, but if you take away some legal settlement costs and some other stuff, it was 41 cents. But I mean, you always want to, I guess, kind of just assume you're going to have something in the mix, right? But let's look at their revenue growth, right? Their earnings and the revenue. The revenue was going up really significantly, really well over 2022, 2023, into 2024. But then they had to do the Pepsi distribution, integration and all that. So everything went down. And as you can see, that hurt. If you look at the chart, you can see it'll hurt the stock price, but it hurt the revenue and did a lot. Now with Alani Nu, and the Pepsi integration being done, then they acquired Alani Nu, and now that's basically going to be done. I mean, you look at the revenue, it's going up so much, but the EPS has kind of been bouncing around. The EPS should start really skyrocketing here because they're not doing all these distribution changes into Pepsi and then buying Alani Nu and then integrating Alani Nu like they've been doing so much. Eventually this EPS is I believe, going to grow very, very significantly. So that's just my opinion. If you look at the stock price, like I said, it's really gone nowhere since 2021, which is insane. It's gone negative 65% in 740 days. So, I mean, yeah, over the recent few days, it's gone up. I mean, it went from under 30 to, but you look at this chart. I mean, it has so much room to run. The top was almost 100, right at 100, right there. Right, that line is 100. So close, right? Has so much more room to run, right? And the business was not doing its, even though it was like the revenue and everything was going up. This is when they started the Pepsi integration and all that. Now the company itself, right now, revenue-wise, EPS, all this stuff is going to be way better than the company was back here, right? Way better, even back here. So I do believe the stock will eventually hit that 100 mark. When in the next 12 months, maybe, could. I mean, it's volatile enough that, I mean, it was at 65 just a couple months ago, right? Right, yeah, in about like maybe half a year ago. We're almost at 60 this year in 2026. So this thing does go up and down a lot. I do think it could hit 100 in the next 12 months to 24 months for sure. Let's look at actually what the stock or what the company, the difference is between August 2021 and then May 2026. So stock price has not really gone up much, about 17. I think it's gone up now a little bit, but the market cap, about 30%, but the revenue's gone up a lot more, the net income a lot more, diluted EPS a lot more, right? And the forward PE ratio is now like normal, right? When it used to be at 420. So when you look at this, if you were to look at these two stocks, you'd 100% buy this stock. You'd buy this stock over this stock every single day, right? So, but it was about the same price, right? The stock price was almost the same price. So, I mean, this thing, the stock price can go up. This is some projections. If their revenue growth goes up 30%, that's it. Their net income goes 40%. This would be their EPS. Now I put a low, like their low PE and the high PE is 20s and 30. I think that's, that would be a typical market. But if you're growing at 30, 40%, you probably could command a higher PE. But still, this is a low PE. And you look at the stock price. I mean, it could be almost 200 by 2030. It could be 127 by 2030. Compounded annual growth rate. If you know anything about this anything at 20 is amazing. If you get something at 20, right? When people say, oh, you're getting when you invest in the stock market, you're going to get 11% on the market, 12% on the market. They're talking about how much every year you're getting, right? Well, that's the average. It's about 12. I mean, they say 8%, could be 12%, 10%. Depends on the NASDAQ, the S&P 500, where you're going exactly. But if you're looking at an individual stock that can grow at 38 on the low end, 38%, you are out beating the stock market clearly. You're doubling the stock market. Oh, you're tripling the stock market, right? They're growing at 12%, you're growing at 38%. So, I mean, these are doable numbers. These are doable numbers for Celsius. Salesforce, that's my number 3 to watch. Now, they just came out with their earnings. I give it a B+. Their revenues went up 14%, or total revenue went up 13% year over year. The total cost of revenue went up 13%. That's what I don't like. I don't like this to be very close, definitely not the same or above. So that's why I knocked it down as much as I did. Operating costs were 11%, and okay, but the net income was up 37%. Diluted net income or EPS was 52%. So, I thought this was a good income statement. Not great. I want their revenue to grow more, but this company doesn't grow revenues that much. They're starting to become a bigger company, but they are growing. They are expecting to hit $63 billion of revenue by fiscal year of 2030, which to them, like for us, normal, right now it's May 28th of 2026. To them, their fiscal year, it says 2027. So that's just how they do it, right? It says right here, second half 2027. They just released their second quarter of 2027, but it's May 2026. So this is just how they do it. Anyway, $63 billion of revenue that they plan to make in fiscal year 2030, or for us, calendar 2029. They also are doing a huge repurchase of their stock. So they're planning to put a total of $50 billion in repurchase, right? They're going to buy back stock like crazy. Another thing about Salesforce, why I think it's a stock to watch or buy, it's a highly complex and very difficult undertaking if you want to transition out of it. The platform's deep integration into business processes, custom coding, and vast data volume create significant sticky barriers to exit. It has a lot of data migration and integrity, right? So massive volume. You'd have to move so much data, it'd be crazy. The complex mapping, so Salesforce unique data architecture, it's not going to map to someone else's. So you're going to restructure everything. And then the data quality, migrating dirty or inconsistent data it just becomes kind of a mess, right? Then you have to technical and process, right? You have customization, replicas, and integration breakdowns. So you just have all these things that just make it harder for a company to transition out. And then of course the time and cost. It would take $150,000 to up to $500,000 in 6 to 12 months to actually get out. Plus, they already have people in their contracts and stuff like that. So once you're in Salesforce, it is kind of hard to get out of it. Then you have the human factors, user resistance. Now all their employees have to change into something else, and you have to train them. So that makes it hard to get out of Salesforce when why do all that? If Salesforce is going to continue to grow and continue to be better and better with their product, you're not going to go through all of that just to, possibly just go with someone just as good, maybe a little bit better, I don't know. It's not that many companies that are better than them in what they do, right? So the top 3 rewards of owning the stock, you have dominant AI monetization via their agent force. You have aggressive capital return program, which is the stock buyback, and then it's already right now at a deep valuation discount. So it usually will be, it's right now at 25p. It's actually lower than that. And it's its historical average of 132. So I'm not really going to count that in because 132 PE is ridiculous if you're only growing 13%, right? But it is lower than it has been before, right? Because I mean, you're talking 0%. This thing has grown since 2020. This company, the stock has not gone up since before COVID. Let's see what the company was. The stock price was 182 right now. Well, it's around 180, but when I took this, it just took the May price 173. So about, let's say, flat. The market cap, I would say probably it's about flat. It's saying all this, but roughly, right? It's almost the same. It's actually a little bit less. The revenue is up 142%. The net income is up 100%. Diluted EPS is up 145%. And the forward PE is down 77%. Again, it's just like the Celsius, like which stock are you going to buy? This one or this one? Every single day of the week, you're going to buy this one. And so, this company, this stock, I think it has room for growth. It's a dividend payer. It pays out a dividend too. So, I mean, look, I'm going to go over numbers on why I think the stock can get to a certain price. Because I'm not just going to be saying, I think it can get to this price just for no reason, right? So this is their net income, how much they were making, right? So they were making $1.1 billion and trailing 12 months is about $8 billion. So let's see what that is. Let's see what the compounded annual growth rate for that is, because that's what it really means, right? So if we took 1.1 and we did it over the 8 years and we made it to about 8, you have a 28% compounded annual growth rate, right? So, and this would be their net income, right? So let's say that my bull case, this is a bull case. So let's say I did it at 25%, just 25% for the next 4 years. The revenue growth goes up 11%, right? That seems doable, as they've reported these numbers already. And then the PE would be 15, the high PE is 25. I mean, look at these numbers. Look at the compounded annual growth rate. We're talking 31 to 70%. I mean, the stock could be at $400 to $700 in 4 years, which gives you a really good compounded annual growth rate. So, again, just looking at simple numbers, even if we take it down a notch, let's take their net income growth down 20%. Right? Now you're doing 20%. You look at, okay, now the compounded annual growth rate, and I also lowered the PE. The CAGR is at 2, 8, and 11, which is definitely not great. But then you look at just if you have a closer to the higher PE of 20, which it should command higher, closer to the 15 to 20 range, you're now looking at a 45, 36, and a 32%. So, yes, there is a chance that this thing doesn't grow as fast as I would like it to, but how they have grown over the last 8 years was 28% net income growth, right? And if you're doing that, and that would hit let's go back here. Remember 2030, which would be our year 2029, they said 63 billion. This is how much I have, under 63 billion of revenue. And then their net income growth, right, 25%. So this is just what it should be based on what their estimates are and what it's gone over the last 8 years or so. So that's just why I think Salesforce is a company to watch. Now, on to my fourth one, ServiceNow. ServiceNow has 630 customers spending more than $5 million every year. They have JP Morgan, Goldman Sachs, they have Amazon, Microsoft, United Health Group, CVS, General Electric, and then they also have the VA and the Department of Defense. So they are obviously dealing with some big companies, big people. They're considered one of the stickiest products in enterprise software. They have best-in-class retention. They consistently maintain 97 to 98% renewal rate. So that means like every year, 97 to 98% of their customers come back. So they're going to constantly be getting more customers. As long as they get just 3% more, then you're going to be growing in customers, right? And then the workflow, it doesn't just sit alongside other tools. It acts as the control layer that coordinates and works across everything, right? And then the net dollar retention is 125%, which means not only are those customers coming back, but they're spending more. Instead of just spending 100%, they're spending more in the next year, right? So that's good. There's also, just like Salesforce, it's hard to transition out of it. Transitioning out of ServiceNow is often described as a nightmare scenario due to complexity in time, customization trap, and institutional knowledge. Very, very similar to Salesforce, right? So all the people who use ServiceNow for certain things and certain services and products, whatever, it is very hard to switch out of it. So that's just one thing they got. And again, someone back to 2020, I mean, this is after COVID, but October 2020, the company hasn't really done much since then, right? At least the stock. The stock has not done anything. 0% since October 2020, but it's down 56% since January 2025. But let's look at the company. October in 2020, stock price was around the same, right? Market cap around the same. The trailing 12 months revenue, $4 billion. Now they make $14 billion. Net income, $600 million. Now they make $1.7 billion. And the diluted EPS was 62 cents. Now it's 168 cents. And then the forward PE, as you can see back then, even back then, right? Not like, we're not talking the PE being way up here. No. We're talking here, October 2020. The PE was 160. Now it's at 20, right? So again, you take this all day, every day. This seems like a good price when you see their, how much they're growing every year. Seems like a good buy. So that's number 4. Number 5 is Micron. I made this, I think I already said it maybe once or twice. I made this list like within a week. I started last week. I had Micron on my list. I added a little bit to my position, and it started skyrocketing already this week. I was like, why couldn't it just wait 1 week? 1 week and I would have looked so much better. But I'm still putting it on the list. It is what it is, because I still think it has room to grow. Even from here, even from where it is today, I still think it has room to grow. Right now it's at $900, in case you're wondering. So they just came out with their earnings as well, A+. I mean, revenue up 124%, net income up 451%, diluted EPS 442%. They're killing it. Now, this is when I had it, when I had initially put it on my stocks to buy. It was around $750. And you can see the forward PE is 12, almost 13. But the EPS is about 58, right? Well, now it's at 923. Again, the EPS is 58, but it just went up, the PE went up about 2, and I was going up a couple $100. I'm like, $150, something like that. It's messed up. So anyway, I still believe Micron is a stock to buy and watch, though. I still think it could go to 2,000. So I'm going to explain why. Doesn't mean it's going to be long-term in 10, 20 years. Like all these semiconductor, all these, all the chip companies, all of them, they're cyclical, right? So they're going to go up and down. But right now, Micron is simply printing money because of AI. It cannot function without the massive amounts of memory, and Micron builds a gold standard of that memory. So they have in advanced AI chips like NVIDIA, they need to read and write at lightning speeds. The traditional computer memory is too slow, so Micron solved this problem, and now their HBM, high bandwidth memory, just moves really faster. And then NVIDIA actually integrated them directly into their top tier AI platforms and all that stuff. So, Micron is already really integrated into the AI infrastructure and is needed. Then you have the artificial storage. The HBM are incredibly complex to make. Manufacturing just one takes roughly 3 times the physical manufacturing capacity of a standard. So by shifting their manufacturing to focus on heavy margin or high margin HBM chips, it reduced the global supply of the standard memory used, right? So they basically said, look, we're not going to make the standard memory anymore. And they essentially just caused a massive industry-wide supply crunch, allowing Micron to raise prices across its entire product line, because they stopped doing regular, memory, and it created a glut. You couldn't find anymore, a shortage of memory for regular computers. Then they have pre-sold memory. The demand for AI memory is so intense that Micron has effectively sold out its entire HBM production all the way to the end of 2026. I mean, that's great. The next 5 years, the business and industry looking ahead, Micron is transitioning from a volatile commodity company into a central piece of global premium AI infrastructure. So they're really trying to, be like, you need us to keep going and to be, having this AI infrastructure. Massive expansion of made in America chips. Now, the building of the semiconductor factories is incredibly expensive, multi-year process. Confident that this AI demand is permanent, Micron is running a staggering $25 billion plus CapEx program. So over the next 5 years, major new manufacturings in Idaho and New York, heavily supported by the government CHIPS Act funding, will come online, making Micron a powerhouse for domestic advanced memory manufacturing. So they're going to have that made in the USA type of, brand and feel, I guess, and label. Then AI moving to the edge. Right now, AI boom is happening inside massive data centers, but over the next 5 years, it will also shift into the personal devices like your smartphones and even the cars, right? Our cars are not nearly as smart as they will be. And they're the leading automotive memory, right? In that sector. So, they're leading in a lot of things. And what's to stop technology and AI? Like, technology, the way it's moving, this next stage, we're going to need a lot of memory, a lot of just random memory. The 5-year financial trajectory, they predict that the revenues could scale dramatically, with some aggressive estimates pointing to $263 billion in cumulative sales over the next 5 years. Micron's revenue is becoming highly predictable due to long-term multi-year contracts with cloud giants, which is good. Now, the one risk to watch is a return of competition. The Micron's golden era over the next 5 years is a threat to oversupply from massive Korean rivals like Samsung and SK Hynix. I don't know. If those competitors aggressively build too many factories later in the decade, the industry could face another classic oversupply glut, which would inevitably compress their profit margins, right? But for right now, Micron holds a distant technology lead, and it shows no signs of slowing down. So I wanted to compare Micron to Western Digital, Seagate, and Intel, the American companies that are kind of like the closest to that. They've all gone up significantly. This actually took a week ago or something like that, so they've gone up since then. Micron, strong buy from everyone. I mean, you look at this compared to everyone else, right? Strong buy from everyone. And then we have over here, number one, sector rank, right? Industry rank, number one out of all of them, just dominating. You look at, I'm using Seeking Alpha, and they have a lot of analysts and stuff like that, so this is kind of what it's going off of. But the valuation, growth, profitability, everything is just, it beats everybody else, or it matches, except for, I guess, EPS revisions, but it's doing very well. And you look at the forward, now it's at like 15, right? But still, you look at this compared to the other ones, I mean, come on. You're going to pick Micron, right? And then compared to the revenue growth, you have 85% compared to them, right? The revenue of the 5 year, the CAGR, the compounded annual, they have 20%, which is way better than them. And you have a negative 7% on revenue, that's crazy. Net income, the last 3 years, your compounded annual growth is 146%. Look at them, they got nothing. Micron's the winner right there. Gross profit margin, 58%. Net income margin, 41%. The only one right here is Western Digital that has a better net income margin for now, maybe, right? But their gross profit is better. And the revenue just destroys everyone else, right? The EPS destroys, net income destroys. So they're doing very well. Micron is a stock that I would be looking at when you just look at all this. Their total cash, total debt. Now they have a lot more debt, right? So, but they have more cash than debt. So that's good. Cash flow, amazing, right? CapEx, of course, they're spending a lot more, but we just talked about that. That's what they're going to do. Now let's look at the revenue growth. These are just conservative numbers, right? 50, 40, 30, 20. That's the rate that they're going to grow the revenue. Net income is just going to go up 40, 30, 20, and 10. So this is what, and I put low PE because these things, it's just been stuck at low PEs. I mean, when I initially put a little position in it, it was at 9, 10. I almost thought it was too good to be tried in. I was like, does this make sense? But anyway, I put a low PE, 10 to 20, and you look at this. Look, it still can go to $2,000. Easy, $3,000, almost $4,000. On the low end, $2,000 in a few years. Right? I mean, that's insane. That's insane. Now, I lowered it. I lowered the revenue growth and the net income growth a little bit. The PE I kept the same, 10 to 20. And as you can see, you don't have as much of a good CAGR, but you still have a good compounded annual growth rate. Now, it did go up to now 920. I think I took this after, let me check. Yeah, see, $943. So this is at $943. This is after it went up in this last week. So, you're still making money. You're still making plenty of money off Micron, even though it's gone up. So thank you for watching. That was 30 minutes. I appreciate everyone who watched. Well, hello. Who's been watching. And it's been a little bit of a crazy week for me. I'm going to get back on to the videos a little bit more, but I had to go through these top 5 stocks to watch. Things changed a little bit on the week, especially with Micron. I think it's still a long-term play. The other ones Micron, I believe, it still could be a long-term play, but it's very cyclical. It's going to go up and it's going to go down. It's going to have its moments where people, all of a sudden the industry is really bad and then the stock could really fall. Something like a Salesforce and Now, I believe, is just long-term forever. I mean, not forever, but you can really hold on to those things because they are integrated so much into systems and they do so well. And then Celsius and HIMS, they're very volatile, but I think they're in the baby stages kind of, right? I believe Celsius is actually doing better. They've already acquired, they've already integrated, they've already done all this stuff. I don't know why the stock hasn't gone up. So I think Celsius is out of the baby. So they've already they acquired their Lonnie New. Now they got more shelf space. Okay, let's go, right? HIMS is the one that's still acquiring businesses, still going through the integration of Wegovy and Novo, right? They're still getting their steps going. So HIMS, I understand, is a little bit bumpier. Celsius, I think, should just be flying. So yeah, Celsius would be my number 1 stock to watch if I had to pick out of all these and put money on it and you're going to double up quicker or, whatever. It would be Celsius. So anyway, yeah, thank you for watching. I really appreciate everyone who does watch and likes and subscribes. And never forget to earn it, save it, invest it, buy low, sell high. I want assets, not liabilities, and you can count on compounded interest.